Good afternoon, everyone. This is going to be the recorded session that for our normal class on September 24th. Hope you are all doing well. What we're going to start with is to go over the whole concept of marketable securities. Okay. And we're going to talk about what marketable securities are. Okay, why publicly traded corporations basically purchase stocks and bonds in other publicly traded companies, and continue from there. Okay, so we'll start with slide 3032. All right, so the first thing we're talking about here is marketable securities. All right, marketable securities basically are those securities, okay, which a publicly traded corporation chooses to invest in, okay, in the short term, all right, because they have excess cash available. All right, so here, we're talking about a publicly traded firm, again, investing in the stock or bonds payable of another publicly traded organization. Okay, so let's say, again, the example I used in class was what happens when Apple wants to basically purchase Amazon stock or bonds. All right, again, Apple has excess cash available. They basically don't want to leave those funds idle in their checking accounts. So just like individual investors like you, what are they going to do? They're going to choose to invest in marketable securities. Okay, now, again, when we talk about marketable securities, we're talking about short-term investments, okay, and they are very liquid resources, okay, of the corporation that's buying them, okay? So they are so considered so highly liquid, they're as close to cash, okay, but not quite cash yet. Okay, so a corporation chooses to purchase these securities basically because what are they anticipating? They're anticipating that the market value of these shares or bonds are going to increase. Okay, they're also anticipating that if they're purchasing shares of stock in another publicly traded company, and again, GAAP requires that U.S. corporations only invest in other publicly traded corporations. They cannot invest in private corporations. Again, if they're buying shares of stock in other companies, they're anticipating that they're going to be getting dividends, either stock dividends or cash dividends on their investments. If they're buying bonds payable in other corporations, they're anticipating that they will be receiving interest on a semi-annual basis. Okay, again, due to the fact that they are sold on a public exchange, okay, that's why their value can always be determined at a glance, okay, and also they are highly marketable. All right, so if you buy, just like an individual, if you buy shares of stock or bonds, you know, you just have to call your broker basically, and then you're going to be able to sell those your investments at whatever the quoted price is at that point. Okay, just remember, however, that marketable securities are not basically for, they're not for purchase for control, not controlling interest in the company. Not for a controlling interest in the company you're buying the securities in, or for the long term. Okay, so Apple has no vested interest in buying Amazon stock. They're just buying it because they feel that it's a good short-term hold and that they're going to increase their revenues by investing in the securities of an outside publicly traded company. Okay, again, if they are highly liquid marketable securities, okay, that means that they are going to be reported on the balance sheet directly under cash. Okay, so the cash account is the most liquid account. It will appear first, then directly underneath that you are going to see the account for marketable securities. Okay, and the way we're going to be treating these marketable securities is going to be very different than any other current assets that we have been dealing with. Okay, but just right now, what I want to do is just go over some of the journalizing and record keeping for these type of investments, and then we'll see what happens later on. Okay, and again, the marketable securities are listed directly under the cash. Then you would have your other short-term asset accounts such as inventory, the long-term assets, etc. Okay, if these are investments and in other companies, okay, and they're determined not to be marketable securities, okay, they would, those securities, again, they're being controlled, they're either being purchased with the intent to hold on to these securities for the long term, or because the buying corporation wants to have a controlling interest in the company that they're buying into, okay. If they're not marketable securities, the investment in these companies would be included under the long-term assets, okay, and they would just be listed then as investments, general investments under the long-term assets. Okay, what we're expressly interested in, okay, in this chapter is basically the marketable securities that are listed here right below cash. Okay, and again, that's because of their high liquidity value. All right. Now, again, when we talked in class last Tuesday, I was discussing that this is not an insignificant point. Okay, these marketable securities. If we look here at some, again, these numbers are a little bit outdated, but if we look for some of the larger publicly traded corporations in the U.S., we'll see that the amounts invested in marketable securities, and remember, these amounts can vary every single day. Okay, they're basically purchased for the short term, but whenever the corporation feels that it needs additional liquid cash, okay, they could sell these securities at any point, or a portion of these securities at any point that they so desire. Okay, so but we see that the dollar values maintained in these marketable securities accounts are substantial. Okay, so our first example again is going to be Foster Corporation. Okay, Foster Corporation is basically buying securities in Coca-Cola, which, yes, is a publicly traded company. Okay, and here we're told, right, they're buying shares of the Coca-Cola company, meaning they're buying shares of stock. Okay, so Foster paid $4,000 times the $48.98 per share. Okay. In addition, Foster also paid, and you'd always be told this amount, Foster also paid an $80 total brokerage commission on this particular trade. Okay, so what every corporation must do, and again, you on the corporate books, you're just going to see a total on the balance sheet, let's say for Foster Corporation, of the $196,000. Okay, that's the total amount of the purchase. Realize, though, okay, that in addition, Foster is going to always, whenever they purchase any marketable securities, they're also going to have to determine what their cost basis in these securities is. Okay, so for our purposes, All right. When we talk about the cost basis, we are always going to include any brokerage commission which was required to be paid, okay, by the buying corporation. So here, since they needed to pay $80 in a brokerage commission, they would not have been able to purchase these securities in Coca-Cola unless they paid the brokerage commission. That's going to be tacked onto the cost. Okay, so the total cost to Foster Corporation for this purchase, okay, equaled $196,000. Okay, in addition, we know that to figure out what the cost basis per share is, okay, and this is going to become very important later on when we see that when we sell these, when Foster sells these shares of stock, okay, we're going to see that that becomes very important at that point. All right, so here we're going to debit on this day, December 1st. We are going to purchase the marketable securities account for the $196,000 and credit Foster's cash account. Okay, and then we are also going to make a note in Foster's records, okay, that the cost basis for these shares for this purchase on this day was a total of $196,000 divided by the 4,000 shares. So the cost basis on this day for these shares equaled $49. Okay. All right. So now what happens? All right. We know again that Foster invested in these shares because they hoped the market value would increase. And again, since they purchased stock, all right, here we're told that on December 15th, Foster received 30 cents per share, okay, in a cash dividend on their 4,000 shares, which were owned of stock in Coca-Cola. Okay, so the 4,000 shares times the 30 cents cash dividend per share equals regular revenue to Foster Corporation of $1,200. So again, Foster is receiving cash, okay, that is going to be debited, cash is being increased, and they are going to credit their dividend revenue for $12,000. Okay, I'm sorry, for the $1,200, excuse me, $1,200. And again, this is going to appear on Foster's income statement, okay, at year end as one of their regular revenue accounts on their income statement. Okay. Okay, remember that these are marketable securities, so by definition, okay, Foster's intent or Foster's management's intent was not to hold on to these for the long term. Okay, so when we're talking about marketable securities, all right, when we're talking about marketable securities, the intent of management is that these securities are going to be sold within a year of purchase. The intent is that they are going to be sold within a year of purchase. Year of their purchase. Okay, but remember earlier when we were looking at the marketable securities accounts for companies like 3M, for companies like Ford, again, they had billions of dollars, okay, in their marketable securities account. So realize here we're using a simplified example for Foster Corporation. Okay, they had marketable securities in only one other corporation, in Coca-Cola. In actuality, okay, in real life, when a corporation invests in marketable securities, they are going to be investing in a large variety of stocks and bonds in publicly traded securities. Okay, When we look on the balance sheet, we are just going to see one account typically. Okay, so on the balance sheet, we are only going to see one account appearing with the marketable securities heading, right? Okay, realize though that typically that account is made up of a lot of different investments in many, many different publicly traded companies. So it is important, okay, that the purchaser of these marketable securities maintain all the details for all their different investments, okay, which in their investments in marketable securities. Okay, just so that, first of all, they ensure that they hold on to these securities for less than a year. Okay, and also they track what the progress of their investment is at any particular point in time. All right, so again, on the balance sheet, we see one account which has the title for marketable securities. In actuality, realize that it's made up of many, many securities from different companies. All right, and the detail is not provided on the balance sheet. It's just too much information. Okay, so now the next day in the life of a marketable security, here again, you would be told this information. Okay, on December 18th, Foster Corporation sells 500 of its shares of Coca-Cola stock for $50.04 per share, less a $20 commission. Okay, so the first thing we're going to realize is that, okay, so Foster Corporation originally on December 1st purchased 4,000 shares, 4,000 shares of Coca-Cola. Okay, then what happened on this date, on December 18th, they're selling 500 shares. All right, so what is the amount of their remaining investment in terms of outstanding shares? It equals 3,500 shares remaining. Okay, now, however, we have to figure out what price are we going to now, are we going to assign to the various accounts on the date of sale, which is December 18th. Okay, so here, all right, the easiest to figure out is the cash. Okay, now what were we told? Okay, on this day, all right, Foster Corporation was quoted a market price of $50.04 per share that they were selling. They sold a total of 500 shares. Why? Probably because Foster Corporation determined we need some excess cash. Okay, we don't have enough liquid cash in our cash accounts, so we're going to sell off some of our marketable securities so that we are able to pay off any liabilities, expenses, etc., which may be coming due shortly. Okay, remember though, you're always going to be told the price of a particular transaction. Okay, remember, just like when on December 1st, the corporation paid a brokerage commission to purchase those securities, so it increased the overall price of the securities to $196,000 in total. In this instance, when they are selling securities, okay, since this corporation is now selling 500 of those securities on this day, all right, we have to factor into the sales price, okay, or into the cash received that Foster had to pay $20 for this transaction as well. Okay, so what was the net amount after the commission that Foster Corporation received for this sale on this day? They received a total of $25,000. Okay, now remember, just like any other asset account, when an asset is sold, you always have to you always have to credit the account for whatever the original cost or book value of that asset was. Okay, now remember, going back to December 1st, on December 1st, okay, remember we calculated, after taking into consideration the brokerage commission, we determined on December 1st that the cost basis in these shares, okay, was $49 per share. All right. So here, what was the cost basis? Now, for these shares, what are we going to credit to the marketable securities account? We're going to take the $49 times the 500 shares sold on this day. And that means basically we are going to reduce, okay, or credit the marketable securities account for the original cost of those 500 securities, which equaled $24,500. Okay. So again, just like any other asset, when you sell any other asset, you know you have to debit the cash, increase the cash. You have to credit the related asset account for the cost of those of that asset. And now we see here that there's a difference. There's a difference between the debits and the credits. The difference is a credit difference for $500. So what is the account that is going to be credited on this day for the excess? Gain on the sale of investments. Okay, and remember, this is going to be another revenue account that is ultimately going to be reported on the income statement. Okay, a regular revenue account that is going to be credited on the income statement. So we had a gain of $500. Again, that's why the corporation invested in this stock. Okay, it wanted Foster wanted to liquidate a portion of it, and again, realize that when a corporation sells stock, okay, that is considered a realized gain. Okay, it's a realized gain, meaning it is going to appear on the income statement, and it is also going to have a tax effect. Okay. This transaction is going to have a tax effect. It's a realized gain, and it is going to appear on the income statement. Okay. And remember, the gain is only the difference between the cost basis and the amount of cash received on this day. Okay. So now, again, very normal for this to happen. What happens next is that on December 27th, okay, Foster decides it needs more cash. Okay, on December 27th, it decides to sell an additional 2,500 shares. Okay, now remember, after the first sale of 500 shares, Foster owned 3,500 remaining shares. Okay, in Coca-Cola. All right. Now, as of this date, since they're selling 2,500 additional shares on this day, after this transaction, how many shares of Coca-Cola is Foster Corporation going to be left with? After this sale on this day, they are going to be left with a total of 1,000 shares of stock in Coca-Cola Corporation. Okay, so here on December 27th, Foster Corporation sells an additional 2,500 shares, and you're always going to be told what the market price is at the particular time that the securities were sold, which is $48.01. Okay. In addition, you're told, okay, that Foster had to pay a $25 brokerage commission on this day. Remember, a brokerage commission paid, okay, means that Foster received less cash for the sale of these securities. All right. So again, the market price on this day was, let's figure out the cash that was received by Foster first. Again, that's the account that's going to be debited. That's the easiest one to calculate first. So the cash proceeds were $48.01, okay, on this date, times the number of shares sold, which equal 2,500. And remember, from the sales proceeds, the broker is going to remove an additional $25 from the sales proceeds, okay, because that's their fee for basically processing this transaction. So what's the amount of cash that was received? by Foster Corporation for the sale of their marketable securities, they received a net of $120,000. Okay, so that is what gets debited. Then, okay, we're going to look here and we see now what is the amount that the marketable securities account, remember that short-term asset account, how much is the marketable securities account going to be reduced or credited by on this day? Okay, so what are you going to determine? Okay, you know the cost basis. Okay, you remember, go back to December 1st when these shares were first purchased. So the $49 cost basis to Foster for these shares times the 2,500 shares, okay, means the cost basis for these shares at the time of purchase equaled $122,500. Okay, that was the cost basis. That's how much we're going to credit the marketable securities account for. Okay. All right, so we know, we could see here, we debited the cash for $120,000 on December 27th, and we credited the marketable securities for $122,500 on this day. All right, however, right away we notice that the debits do not equal the credits. Okay, there is a difference. Our credits are greater than our debits by the $2,500. So what do we have to do? We have to debit an account for that $2,500 to make the two sides of this transaction equal. Okay? What does that $2,500 represent? It basically represents the loss on the sale of these marketable securities. Okay? Again, the corporation paid $49. Yes, of course, per share. Yes, of course, when they first purchase these securities, the desire at that point, of course, is always to sell them at a value higher than the market value. Unfortunately, it appears that Foster needed this corporation, okay, to fund some of their activities. All right, so they had to liquidate these shares of stock. Okay, so they sold it at a loss of $2,500. Remember, since these shares were actually sold, okay, that means that the loss is a realized loss. Okay, it is a realized loss, meaning that it is going to appear, okay, on the income statement, okay, and that the income taxes of the corporation are going to be affected by the fact that they had this amount of loss. Okay, and typically, again, what happens when a corporation indicates that it had a loss for a particular time period? Remember, losses are like are treated similar to expenses on the income statement. And what happens is that it lowers the amount of taxable income. And therefore, the resulting taxes the corporation paid is going to be less as well. Okay, so whenever there is a sale of securities, remember it is a realized loss. Okay, now, what we're going to see now, all right, is that when a corporation has marketable securities, okay, marketable securities, basically the remaining marketable securities at year end, okay, defies one of the basic cost principles that we have. Okay, so what happens only at year end? Okay, only at year end. Okay, what's going to happen is that for corporations that invest in available for sale marketable securities or short-term marketable securities, what's going to happen only at year end? Okay, they're going to, since these securities are considered so highly liquid, okay, or in other words, they're so close to cash. at each and every year end, what the corporation is allowed to do is that they may adjust the market value of the securities. Okay, they can adjust the marketable securities to the market value. Okay, now, whenever we've talked about assets in the past, okay, we know that the cost principle is one of the first principles that you learned in accounting. Okay, this particular situation violates the cost principle. Okay, meaning that, remember that typically we have learned that any asset, okay, is always, any long-term asset or short-term asset is always going to be listed at its cost, okay, on the balance sheet. Here, okay, now remember, how many shares of stock does Foster still own in Coca-Cola? Foster still owns 1,000 shares at year end. Foster still owns 1,000 shares of Coca-Cola stock. Okay, remember, Foster did not sell those shares yet. They are still the owner of 1,000 shares of this stock. Okay, but this is the one instance where, since these shares, okay, since marketable securities are sold, basically are so liquid, okay, basically what happens is that the asset account is going to be adjusted to the market value of those securities. Okay, so the marketable securities are going to be the marketable securities are going to be adjusted, okay, adjusted to the fair market value. Okay. We really have never seen this taking place. Market value. We've never seen a situation like this on our books and records. Okay, we always have been focusing on the cost principle. Okay, and typically, had we just been continuing, remember that we owned 1,000 shares of Coca-Cola stock. So using our previous principles or what we've learned in the past, we would just value, again, because these securities were only purchased at December 1st, we would normally have used, based on the cost principle, the $49 per share as the value as the book value that's going to be reported on the balance sheet. Okay. Marketable securities or available for sale market securities violate the cost principle when their value is reassessed at year end. Okay, so marketable securities are revalued at year end. Okay, their value is going to be adjusted to the fair market value. And again, the value of those marketable securities revalued if the fair market value increased or decreased at year end. Okay, so the value of the marketable securities is going to be revalued if the fair market value increased or decreased, okay, on the last day of the year. All right, so we never really had a situation like that, particularly where we had instances where the fair market value of an asset increased over time. Remember, we never wrote up the fair market value of any asset. okay? Because we have to first abide by the cost principle and also basically abide by the principle of objectivity, okay? It had to be an objective value for those securities. Here, GAAP makes the first major exception, okay? Realize though, okay, the securities have not been sold on this day, right? As of this last day of December, okay, on December 31st, these securities have not yet been sold. Foster still owns 1,000 shares of Coca-Cola on this day, okay? But what happens, all right, remember the cost basis in those remaining 1,000 shares is basically the $49, which was the purchase price or the original cost basis, times the number of shares outstanding, which is 1,000. Okay, so the cost basis of these shares as of December 31st, 2018 equals $49,000. Okay, very nice. All right, but what other information are we told here? We're told here that Coca-Cola stock actually has, and again, you'd have to be provided this information. This Coca-Cola stock only has a market value of $47,000 on this day. Okay, so what's going to happen? All right, the cost basis, 49,000, okay, but the market value of these 40, if Foster wanted to sell, okay, those 1,000 shares on this day, okay, those 1,000 shares only have a market value, a total market value of 47,000, which we're told here. Okay, now again, please remember Foster did not sell these shares. They're still the owner, but in the event where there are highly liquid multiple securities, highly liquid marketable securities owned by a corporation, they are able to revalue the cost basis. So what are they going to do? We see here that the difference between the 49,000, okay, cost basis and the $47,000 on the last date of the year only, okay, is $2,000. Okay, and specifically what's happening here, the market value of these shares is $2,000 less, okay, than the cost basis in these shares. Okay, now I also want you to realize, since these shares have not actually been sold, okay, this is not a realized loss. Okay, this is not a realized loss. This $2,000 is only a recognized loss. Okay, remember, a recognized loss may appear on the financial statements, but only realized losses are allowed on the income statement. Okay, so this $2,000 is a recognized loss, and what it really represents, that recognized loss, really represents a temporary loss in the value of these shares. Okay, since the value of these shares has fallen $2,000 since the date they were purchased, okay, GAAP basically allows the corporation to recognize a $2,000 temporary holding loss. Okay, so that $2,000 difference is going to be considered a temporary holding loss. All right, now we've never basically come across anything quite like this in any of your accounting studies. Okay, so again, it's a temporary loss. Why? Because these securities are so liquid. Okay, the market value may fluctuate. Okay, again, very quickly, maybe even later on this day, right, on the last day of the year. But it just so happens that when we made our valuation, the market price of that portfolio fell by $2,000. okay? But since these securities are so close to cash, Foster Corporation is going to be able to recognize an unrealized holding loss on the investments, okay? And then that is always, if it's a loss, if it's a holding loss, okay, we're still holding on to these securities, but it's a temporary loss at year end, okay, we're going to recognize that holding loss. We're going to debit that loss, okay? And then what is going to be credited? Our marketable securities account is going to be credited, okay? Now remember, that marketable securities account is an asset account, right? Whenever we credit an asset account, we know that we are going to be reducing the value of that asset account. So yes, that makes sense. We are crediting the asset account. Now though, and this is the trickiest thing in this chapter. Okay, what happens now? What type of account is this unrealized holding loss? Okay, it is not an income statement account. Okay, because remember here, see how it's saying it's an unrealized loss? Since it's an unrealized loss, it cannot appear on the income statement. Okay, so where in the world, okay, because, and why? Because we didn't sell the securities. It's not going to be a realized loss until we sell the securities. Okay, but since it's considered a temporary holding loss, all right, where is this unrealized holding loss going to appear on the financial statements? Okay, and again, this is going to be contrary to anything you've learned so far this semester. This unrealized holding loss account, okay, again, if it's a loss, all right, is going to appear in the shareholder equity section. In the shareholder equity section of the balance sheet. Okay. So here we see the unrealized holding loss on investments. All right. Again, it has a debit balance. So when I tell you here that it is going to appear in the shareholder equity section of the balance sheet, again, realize it's going to be, since it has a debit balance, okay, what is it considered? It's considered a contra equity account. Okay, it's reducing the shareholder equity. Okay, since it's reducing the shareholder equity, it's considered a contra equity account if it's a loss. Okay, so how will this transaction, how is it going to appear, okay, on the balance sheet of Foster Corporation at year end? Okay, how is it going to appear if we look here? Remember, the original cost of our securities, of those 1,000 remaining securities, remember, was $49,000 because the cost basis was $49 per share, right? So here, the 1,000 shares that are remaining at year end, okay, times the original cost basis of $49 per share, that equals the $49,000, the balance that should appear in our marketable securities account. However, since the overall market value of these shares at year end, okay, and again, this adjustment only happens at year end, okay, this adjustment to fair market value only occurs at each year end. Only occurs each year end. Okay, so here, so what are we going to do? We saw here, what was our journal entry? We credited the marketable securities account, but remember that was a holding loss or a holding decrease in our assets. So here in the balance sheet section, we're going to show, all right, what the original cost basis for these securities were. And we're also going to show on December 31st what the revised market value is. Okay, remember that only the revised market value is going to appear on this day. Okay, and remember, it could have been higher as well. It just so happens that it fell for $2,000. So the marketable securities account is going to be reevaluated, okay, for $47,000. Okay, but this information must also be provided here. Then you're going to total, okay, what the total of your assets equals, which is $900,000. Okay, now we're going to turn, okay? Remember we debited the unrealized holding loss on December 31st? Okay, remember this is a holding loss or a temporary loss account. Okay, it does not appear on the income statement. Okay, because it's not a realized loss, it's an unrealized loss. So the only place it appears here is on the balance sheet. And what does it do to the balance sheet? It decreases the amount of shareholder equity. Okay, it decreases the amount of shareholder equity. Remember, because it had a debit balance. All the other accounts in shareholder equity have a credit balance. Okay, this account is going to decrease the amount of shareholder equity, okay, to $550,000. Okay, so what is the total now after we made that journal entry and posted it to the balance sheet? What is the total of our liabilities and shareholder equity section? That equals $900,000. It equals the amount of our assets. So that's fine. We are in balance. Okay, so very different how this type of account is adjusted. Okay, another way that this type of adjustment is referred to, it's also called fair value accounting. Okay, that is when, again, and what's happening here is that the asset account is revalued based on the market value. Its market value, based on, its market value. Okay, and again, it could be higher or it could be lower. Okay, in either way, okay, the market value may be higher or it may be lower. Okay, it doesn't matter. This is the rare situation where you can adjust the value on the balance sheet. Okay. All right, so very, very different. So if I asked you a question, is this a $2,000 holding loss? Is it a realized loss? And your answer would be no. It is not a realized loss, okay? But it is a recognized loss, okay? It's recognized on the financial statements, but it is not realized. Why can't it be realized? Because of the fact that that Foster still owns the stock as of year end. Okay. All right. So now, all right, how long is this unrealized holding loss? Okay. How long is this unrealized holding loss account going to appear on the balance sheet? Okay. So remember, this unrealized holding loss, let's say it only happens once a year when the value of your marketable securities are reevaluated. Okay, so this unrealized holding loss was recorded for 2018. Okay, how long is this unrealized holding loss account going to basically appear on the balance sheet? Okay. It is going to appear on the balance sheet for that same particular balance, for the debit balance of $2,000. Okay, this balance will be maintained. this $2,000 debit balance. The $2,000 debit balance in this account. Will be maintained. Will be maintained until December 31st, 2019. Okay? All right. Since the corporation is only allowed to reassess their marketable security account once a year, okay, the balance, this $2,000 debit balance in the account, in their shareholder equity account, is going to be maintained until the next year when this reassessment is made, okay, for the investment, the marketable securities holdings as of December 31st, 2019. All right, so this is going to exist until the end of the next year. All right. So now what happens? All right. Let's say by definition, okay, by definition, we know the balance in this marketable securities account under normal circumstances can be changing daily. Okay. The amount that basically comprises this $47,000 or more, okay, it can be adjusting. It can be made higher, lower. The specific securities that make up whatever balance of that account is can be changing all throughout the year. Okay? But we're not going to touch this unrealized holding loss account until we actually revalue whatever these marketable securities are as of 12/31/19. Okay, so again, seems a little bit unusual, okay, but that's basically, it's an unusual situation, and because of the fact that these securities are considered so highly liquid, it is allowed for this to basically occur. Okay, so here, Foster Corporation, there's constant changes going in this marketable securities account. Okay, but you're always going to have this the $2,000 decrease existing. Okay, any changes are going to be based on this $47,000 balance in the account. Okay, and this $2,000 debit balance in the shareholder equity account is going to be maintained until the end of next year. Okay, all right, so let's just take an example now. All right. So let's say what happens is that we're going on, and we're the next year, 2019's transactions are continuing. Okay. We started a new year. All right. Now, okay, let's say that on December 31st, 2019, it's a year later. Okay. So what has to happen? What do we know has to happen? Basically have to, or Foster Corporation has to revalue their marketable securities account. Okay, so only at each and every year end, this marketable securities account has to be revalued. Okay, now, let's just say that, all right, so I'm going to erase the information for 2018. We see how we got here for 2018. Okay, so for 2019 now, we're starting, we have to revalue the market value of those shares. Okay, all right. So now what happens at the end of, here, let me just write this down. At the end of the next year, which is 12/31/19. Okay, so let's say as of 12/31/19, all right, again, basically the composition of that marketable securities account would have changed, right? The marketable securities that Foster owns would be different. Okay, and that's basically because the fact that marketable securities, by definition, are going to be held for a shorter period of time or less than a year. Okay, for arguments purposes or for simplicity purposes, let's say that as of December 31st, 2019, okay, and basically, where do we get this information from? How is the corporation, remember, it has to be objective. Where would we get the information from at the end of any year that the marketable securities account, what the revised value of the marketable securities account is going to be at year end? Remember, the corporation can't just make this up. You know, it's gut feeling. What do they feel that their securities could be valued at the end of this year? Okay, it always has to be objective. So let's say on December 31st, 2019, just like they did in 2018, they got a broker's confirmation. There has to be some type of third-party documentation, okay, which confirms what the market value of their existing portfolio is. Okay, so you would have to get a broker's portfolio, okay, and that would basically be the objective proof that the portfolio was actually worth $53,000. Okay, but now at December 31st, 2019, all right, we see that the market value of the securities actually is $53,000. Okay. What's the problem here, though? The problem here is that the marketable securities account is only valued at $47,000. Okay, it's only valued at $47,000. Okay, so what happens? There is a $6,000 difference. Okay, there's a $6,000 difference between what the market value of these securities are and the amount that they're valued at, and also basically what the balance in this unrealized holding loss account should be. Okay, so remember, the balance in this account is only adjusted one time a year. Okay, and is going to be at year end. So this balance for the $2,000 exists for all of 2019 because it was established at the end of 2018, and now at the end of 2019, as is in any other subsequent year, the balance has to be adjusted. Okay, so what are we going to do? Okay, what has to happen on December 31st? All right, what has to happen is that we have to revalue the amount of our marketable securities account. Okay, so we have to revalue the balance in our marketable securities account. All right, so what happens here? Okay, what happens here? The marketable securities account okay, we are told should actually have a balance of $53,000 in it. Okay, but what is the balance right now that exists? Only $47,000. So what happens to the balance in the marketable securities account? The marketable securities account has to be increased, okay, by the $6,000, by the increase in the market value of $6,000. Okay. All right, so the balance in this account now, so what happens here? The balance in this account is now going to equal $53,000 with that debit entry at year end. Okay, but now what's going to happen in this account, in the unrealized holding loss account? All right, we basically know that this holding loss no longer exists. Okay, so, and what should be what should remain now in this account? It should have an unrealized holding gain now. Okay, what should the unrealized holding gain be in this account? It should be an unrealized holding gain, okay, of $4,000. Okay, and it should be an unrealized holding gain of $4,000. All right. So what has to happen? The $2,000 holding loss must be reversed, okay? And you must credit the unrealized holding gain of we want our ending balance to be a $4,000 credit balance of this account. How are we going to end up with a $4,000 credit balance when we have a $2,000 debit balance? Okay, what we're basically going to do is we're going to then record here as a credit journal entry. Okay, we are going to credit the unrealized holding gain of the unrealized holding gain of $6,000. Yes, of $6,000. All right. And that unrealized holding gain of $6,000 is basically going to negate the debit balance in this account as of this day. Okay, it's going to remove the debit balance of $2,000, and it's going to now replenish the account, and it's going to have a gain of a credit balance of $4,000 on this day. Okay. All right, so that would be the journal entry. And again, the $4,000 increase, all right, in unrealized holding gain on investments, the revised value at the end of 2019, the $4,000 unrealized holding gain at the end of 2019 is basically going to appear on the balance sheet, okay, until 12/31/2020. Okay, it is considered a temporary holding account, but again, it's a temporary account in that it is going to be revisited on the last day of the year for all future years. Okay, so while it had a $2,000 debit balance at the end of 2018, at the end of 2019, it had a $4,000 credit balance. Okay. All right. So that is it. And again, remember, it's not a subjective determination as to what the market value of the securities is as of year end. Remember, you have to get an outside confirmation, most likely from a broker, okay, or another knowledgeable source that is verifying the fact that that is in fact its market value, and it must be documented. Okay, so again, what happens here? We are violating the cost principle. When we talk about the marketable securities or the available for sale marketable securities, again, which appear directly below cash on the balance sheet. Okay, this is how basically ends up being a violation of the cost principle. Okay, one of the only situations, and why it's so unique, is that the market value of this particular asset may actually be increased above what its original cost was. Okay, we've never really seen that before. We've seen basically the market value of any assets increasing above the cost. We would see that in a note to the financial statements. And again, we would probably see a note that is backing up the fact at the year end what actually happened in this account, any changes in the marketable securities and the unrealized holding gain or loss. Okay, but here we see that there's going to be an actual change in the financial statements for changes or increases in the market value of an asset. Okay, so unusual situation for us. Okay, here just as a quick aside, remember I had mentioned that in the United States, publicly traded corporations can only make equity investments as marketable securities if the stock or the bonds are traded on a public exchange. Okay, here what happens though under international? Okay, under international rules, available for sale securities, including unlisted equity investments, that is in the international rules, you can, those corporations, basically foreign corporations are able to basically invest in equity, okay, for privately traded accounts, okay, for privately traded corporations. In the United States, you cannot, okay, a corporation cannot invest in a non-publicly traded asset in order to invest in marketable securities. Okay, so a difference again between between what GAAP requires and what the IFARs require for international investing purposes. International companies may invest in closed corporations, okay, while domestic U.S. corporations may not, in order to determine what their marketable securities holdings is. Okay. All right, very good. So now we will continue with the homework for Chapter 7. Okay. Now these homework exercises, again, because this is such a unique chapter, such a unique situation, I want you to pay close attention to this information as we go over it. Okay? So here, this particular corporation, Mumford Corporation, invested $30,000 in marketable securities on December 4th. Okay, so that was the date of purchase. And again, when you're going over transactions or problems like these, where you have a lot of different information, it always helps just to make a note of it as you're reading through. Okay, so purchased on December 4th. Again, these are highly liquid marketable securities, so it's not unusual that 5 days later on December 9th, this corporation sold some of these investments for $10,000. Okay, so it sold it for $10,000, and 9 days later, it sold more of these investments for $5,000. Okay, so the $10,000 and the $5,000 on these two dates is basically reflecting what the cash proceeds were when some of these investments were sold. Okay, this is the amount that Mumford received as the proceeds. All right. Now, then we're also told here that the securities sold on December 9th had original cost basis of $7,000, and the securities sold on December 18th had a cost basis for $6,000. All right, so again, make sure you identify, okay, all the significant matters in the particular problem before you start going through it. All right, so here, A, record the purchase of the marketable securities on December 4th. Okay, so here we're told in marketable securities, again, the intent is that the corporation is going to, the intent is to sell, the management believes that it is going to sell these securities, okay, within the next year. Okay, they are not holding on to these securities for any controlling interest or for the long term. The intent is to sell, and just basically they want to keep it highly liquid, but they don't want to keep an uninvested cash balance. Okay, so on December 4th, when Mumford decides to purchase marketable securities, all right, this marketable securities account, this short-term asset account, is debited for the $30,000. Okay, that's pretty straightforward. That's what we always have seen happening. Okay, but now on December 4th, how did they pay for these securities? Okay, basically Mumford paid $30,000 in cash for these securities on December 4th. Okay, so this is the cost basis now, the $30,000, and they paid $30,000 in cash. So cash was decreased. Okay, now letter B, record the sale of the marketable securities on December 9th. All right, so what happened on December 9th? How much they sold a portion of the securities. All right, so let's back into this. How much cash was received for the December 9th sale? Okay, here we're told that the cash received on December 9th equals the $10,000. Okay, so the cash on December 9th received by Mumford was for $10,000. So we know here on the general journal, the cash is going to be debited for $10,000 on Mumford. Remember, it's always the buying corporation. Mumford sold the securities, they received cash on this day of $10,000. Okay, but remember, like any other asset account, that asset account has to be credited for the cash basis of that account. Okay, for the cash basis of those securities. Remember here, we were told that the original cost for those securities that were sold on December 9th was $7,000. Okay, so what do? You're going to credit that marketable securities asset account for the $7,000 on December 9th. All right, but what do you see right away? You see that the amount of cash they received, the debit for $10,000 does not equal the amount of marketable securities which is credited. Okay, the credits are short by $3,000. So you know what else has to be recorded here? A gain on the sale of the investments. Okay, so Mumford recognized when they sold these securities, which had an originally cost basis of $7,000, they had a realized gain. Okay, on the date that these securities were sold, they had a realized gain, okay, of $3,000 on this day. And that gain will appear, okay, on the income statement. It is going to appear as an additional source of revenue on the income statement. Okay. All right. Now what happened? Letter C. The next transaction is record the sale of marketable securities on December 18th. Okay, so on December 18th, what happened here? Again, let's go to the details. The corporation sold some of their investments for $5,000. All right, so we know then that if they sold some of their investments for $5,000, Mumford is going to debit their cash account for $5,000. Okay, then, but remember, the asset account has to be decreased by the cost basis. Again, we were told here that the cost basis for the securities sold on December 18th was $6,000. Okay, what happens here again? Our debits don't equal our credits. So you know you have to recognize a gain or loss on the sale of those marketable securities. Again, the debits are short by $1,000. So which account is going to be debited? The loss on the sale of marketable securities is going to be debited for the $1,000. Okay, and after this particular entry, our debits and our credits do equal. Okay, and again, this is a realized loss and it appears on the income statement. Okay, and also we know that the marketable securities account is going to have a permanent decrease as well. Okay, based on the fact that they sold a certain amount of their investment as well. All right. Now we get to the tricky journal entry. Again, only happens at year end. Okay, so at year end, here, letter D, record the necessary fair value adjustment on December 31st of this year, assuming that the market value of the remaining unsold securities equals $20,000. Okay, all right, so let's think about this. The original value of the purchase of the securities equals $30,000. Okay, then we also were told that the marketable securities account was reduced. Okay, the marketable securities account was reduced by the sale of $7,000 in marketable securities, all right, on December 9th. Okay. In addition, they had a subsequent sale of the marketable securities of $6,000 at a later date. Okay, so the $30,000 minus the $13,000. What is the minus marketable securities? $6,000. So $7,000 decrease, $6,000 decrease. So what is the remaining value of these securities based on the cost basis as of December 31st? Okay, the fair value assessment was $20,000. So here, what is the market value of these securities? The $30,000 minus the $13,000. Okay, the $30,000 minus the $13,000 equals equals the $17,000. Okay, so that is the cost basis for the remaining securities. Okay, as of 12/31. Okay, but what information are we told here? We were told here that the market value of these securities on December 31st, okay, again, when you do the fair value adjustment at year end, okay, the market value of these securities equaled $20,000. Okay, so what does that mean? It has a cost basis of $17,000. It has a market value of $20,000. So what does that mean has to happen? That means that there's basically an unrealized holding loss for the difference between the two. Okay, I'm sorry, there's an unrealized holding gain. Okay, because the market value minus the cost basis of $17,000 means you have an unrealized holding gain of $3,000. How does that unrealized holding gain get recorded on the books and records as of December 31st? You're going to debit the marketable security account for the $3,000. Okay, and in addition, you are going to credit the unrealized holding gain on marketable securities for $3,000. Okay, and again, what does this journal entry do? It increases the short-term assets of Mumford Corporation by the $3,000. Okay, and again, since the unrealized holding gain has a credit balance of $3,000, what happens to shareholder equity on this date? Shareholder equity is also going to increase by $3,000 So yes, both sides of the balance sheet are still going to balance for this journal entry as of 12/31. But remember that this journal entry as of December 31st does not affect the income statement. Okay, it is just going to basically affect the assets and the shareholder equity. It is a temporary holding account, and it has no effect, okay, on the income statement for this particular year. Okay. All right. And again, what happens, when is this account going to be adjusted, this $3,000 unrealized holding gain? Again, it is going to be adjusted at December 31st for the following year. Okay, for the difference between the market value of the portfolio at that time versus what the cost basis for the portfolio is at that time. Okay. All right, hope that makes sense. All right. Oh, so here, I'm sorry, there's one other question. And date, no, that was it. All right. So, and again here, what was that journal entry for? Here's just the explanation for the previous problem. That journal entry as of December 31st was to adjust the balance sheet valuation of marketable securities from the $30,000 original cost to the market value of $20,000 at year end versus the fair market value, I'm sorry, the $17,000 cost basis versus the $20,000 market value at the end of the year. Okay, so again, violation of the cost principle, particularly when the value of an asset is increased above what the cost was of the asset. All right. All right, so let us continue now with the next problem. Okay, and this is an issue of Wharton. Okay, so Wharton Company pays income taxes on capital gains at a rate of 30%. Okay, so here at December 31st, year one, the company owns marketable securities. Okay, that cost $180,000, but have a market value of $520,000. Okay, remember, by definition, marketables for securities are those securities the corporation purchased with the intent to sell within the next year. Okay, so here we see it's an increase in market value. So letter A, okay, how will the users of Wharton's financial statements be made aware of this investment's substantial increase in the market value? Okay, now remember, all right, this journal entry, they have not sold this investment. Okay, Wharton is still holding on to these securities. It's just that they're so highly liquid that if the corporation sold these securities on this day, they know that they would receive $520,000. Okay, so how is that information, even though the original cost was $180,000? How will this information be communicated to the shareholders of this company or the potential creditors of this company? And here, basically, the amount of the unrealized holding gain, okay, is basically going to appear as an element in the shareholder equity section. Remember, it will appear as a gain on shareholder equity, as an additional credit, okay? And then what else is going to be? The securities are also going to appear in the balance sheet at the current market value. Okay, the value of the marketable securities is also going to increase, okay, by the $340,000 as of December 31st of year one. Okay, all right, so letter B, okay, as of December 31st, what income taxes, and this is pivotal, remember, it's an unrealized gain as of the adjustment at year end. So what income taxes has Wharton paid on the increase in the value of these investments as of year one? Okay, remember that as of December 31st, year one, Wharton still owns the marketable securities. It has not sold any of those marketable securities, so it has not yet paid any income taxes. It's not had, this corporation has not had a realized gain yet. Okay, on the increase in the securities value. Okay, remember that unrealized gains and losses are not, okay, unrealized gains and losses are not subject to income taxes. They're only going to be taxed, okay, in the year that the securities are sold. Okay, now. And again, we've gone through that with the previous exercise. We know that it's just a journal entry, but the journal entry is going to include a debit to the marketable securities. Okay, for if we do the journal entry, it would increase the marketable securities by 340,000, increase the shareholder equity, the holding loss account for the $340,000 as well. Okay, now here, letter C, they're asking us to prepare the journal entry to record the cash sale of these investments as of on January 4th of the following year. So again, we're just going to, just the way this problem is written, we're just going to assume that we don't have to consider the adjustments that were made as of December 31st. Normally you do have to. Okay, but here, what would be the journal entry as of January 4th? Here, the amount of cash, okay, if the market value had not changed, we know Wharton would debit cash for the $520,000, which is the amount of cash they're going to be receiving for the sale, okay? In addition, the original cost of their marketable securities was for $180,000. Okay, the original cost. So that's the amount that would be credited to marketable securities on January 4th. Okay, the debits and the credits, however, don't equal. All right, so here we have to balance the debits and the credits. We know that we have an additional credit of $340,000 on the date securities were sold. Again, on the date that the securities were sold, this gain is a realized gain. It is going to pass through to the income statement, and Wharton is going to have to include this gain on their income statement as a taxable gain. Okay. Now, it's just a little aside here. Remember that if if there were no other marketable securities purchased during this month, they would still need to make a journal entry at the end of December to basically remove the holding gain and the credit to the marketable securities account, the holding loss of the $340,000. Okay, and that's only if we had made the journal entry. So here, I wouldn't just worry about this. Just remember here, it's as if the journal entry had not been made as of December 31st. Okay, for increasing the holding value for these securities. Okay, and then the second part of this problem is, it asks you the sale of securities on just January 4th. Okay, what is it going to do? Okay, remember that $340,000 gain, okay, is going to increase Wharton's taxable income for that year by $340,000. So there's additional revenue of $340,000 in year two, in the year of the sale. Okay, and at that time, the company is going to pay 30% on any capital gains. Okay, and here in year two, what's going to happen to our income taxes? The amount of income taxes that Wharton is going to have to pay is going to increase by the $102,000. Okay, and that's basically because they have a $340,000 capital gains, again, aren't allowed, a $340,000 gain. Okay, at a 30% tax rate. So their income taxes are going to be increased by $102,000. Okay, so if the taxes increase, okay, related to this gain of $102,000, what is the net gain? Okay, based on the number, what is the net gain? Okay, based on the value of what is the after-tax effect of this gain? The after-tax effect of this gain is going to be for $258,000. Okay, is that true? Go one, 200 and I'm sorry, 258. 40 minus 102 equals 200. What am I talking about? Is 238. Okay, $238,000. Okay, 238. All right. All right. So we are done. That's the amount of the net gain. Okay, on the sale of these particular securities. All right. Again, I am going to leave you at this point. I hope that you have a good weekend. Please make sure to review this chapter. Okay. The next chapter, again, is going to be on intangible assets. Okay. Basically, when we're talking about intangible assets, these are very generally, all right, I'll just so I'm going to leave you at this point rather than starting the next chapter. So on intangible assets, which is a subsection of chapter 9. Okay, please read that chapter carefully, and we will be meeting again. Remember, Tuesday is a holiday, so we will be meeting again on October 1st. Okay. Oh, and actually remember that October 1st, I'm going to be indicating this on the in the announcement section. Remember, on October 1st, the first half hour of class is going to be the quiz on McGraw-Hill. Okay, so please remember that quiz is going to be on McGraw-Hill. Okay, have a good weekend, guys, and see you on the 1st after your quiz.